Analysis Wall Street weighs activity cuts as offers slide in battered markets. New York Wall Street bosses are in a bind approximately whether or not to cut funding bankers or preserve them on team of workers in hopes of a recovery from a brutal first one half. With risks of a recession looming and the Federal Reserve elevating prices aggressively to stem inflation, possibilities for arranging and financing offers have dried up. Some banks are continuing to add staff, but the momentum has slowed from final year's frenetic tempo and a few anticipate cuts to be inevitable. While executives at U.S. banking giants mentioned marketplace hobby ought to get better after the first half slump, it's going to probably be modest in comparison with a document year for transactions in 2021. Government stimulus and occasional interest quotes prompt a gusher of offers as corporations rejigged their groups last year, propping up bank divisions that endorse companies. There are quite a few those who suppose that we will get through this brutal uncertainty, and that is why, for example, there's nevertheless plenty extra hiring happening than we would have predicted, mentioned Julian Bell, coping with director and head of Americas at Sheffield Hayworth, a recruitment firm for Pinnacle executives. Investment banks hired 152 coping with administrators within the Americas within the first one half, Sheffield Hayworth stated in a file. That is an exceptionally modest decline from the 192 senior bankers who were given new jobs within the equal length last year, which changed into the busiest on document for the enterprise at Huge. For now, banks have held off on sizable job cuts, which Bell mentioned is because humans comprehend that we're in a pause instead of a catastrophe as a minimum to date. But weak spot has emerged in segments of banking. J.P. Morgan Chase & Company NYSE, JPM, Wells Fargo NYSE, WFC, and Company and other loan lenders have cut group of workers in current months because the enterprise downsizes after having expanded to handle a surge in pandemic call for. Global equity capital market transactions have dropped almost 69% within the first half from a 12 months in advance, even as mergers and acquisitions declined by nearly 23%, in step with Dealogic. Too many people, tough instances this 12 months and a mediocre outlook for 2023 will activate funding banks to reduce 5% to 10% in their team of workers and reduce reimbursement for folks who remain, mentioned Alan Johnson, dealing with director at repayment consultancy company Johnson Associates. They aren't going to pay as nicely, stated Johnson. People are putting lists collectively. Normally this could start out after Labor Day. With the gain of hindsight, companies have too many people. Goldman Sachs Group Inc. NYSE, GS executives said the company has slowed down hiring, and is restarting employee overall performance evaluations, which have been suspended at some point of the pandemic. That annual exercise typically weeds out underperformers. There's going to be greater volatility and there is going to be more uncertainty, CEO David Solomon advised analysts after the organization stated second quarter consequences on July 18. Solomon said, in light of the present-day environment, we can manipulate all our sources cautiously and dynamically. The corporation's headcount swelled to 47,000 at the give-up of June, up 15% from a year earlier. J.P. Morgan, which boosted its headcount by way of 8% for corporate and funding banking inside the second quarter from a year earlier, was also careful about the outlook for transactions. While our present pipeline stays healthy, conversion of the deal backlog can be hard if the current headwinds keep, Jeremy Barnum, J.P. Morgan's chief economic officer, stated on in its earnings call. J.P. Morgan and Goldman declined to tricky in addition whilst contacted by way of executives in financial offerings and different industries, which includes retail and technology, are markedly much less nice approximately deal-making possibilities, in step with a marketplace survey by means of KPMG, an accounting firm. The longer a downcycle persists, greater institutions may be pressured to recall capability discounts, Dylan Roberts, KPMG associate searching at economic offerings approach, told. There are other levers that banks can pull earlier than, or further to, lowering headcount, inclusive of slicing bonuses, he said. A senior investment banker at a European firm New York stated the important thing query would be whether or not M&A comes again in 2023 and if markets normalize. That will be the debate and the discussion that banks can have as we get to the quid of the year, the banker stated.